It is a good afternoon, everyone. Welcome to a weekly review. I'm doing this a little bit early. We're Friday, 2 o'clock, so I don't know, maybe something crazy might happen before the market's closed, but I want to get this out of the way so that tomorrow I have more time to focus on other things. But coming into the week, I noticed that there was double S&T with the Dow making that lower high and making the lower low. I don't really like this because the NASDAQ, and I'm using the bodies, by the way, for the S&T. You can see the bodies there where the dashed lines are. Dow obviously slowed down before the Nasdaq and the S&P did, and now it's making lower high. So I didn't really like that because I usually want to see the Nasdaq be the leading one. So if it's gonna go lower, I want the Nasdaq to make the higher high, because the tech industry is usually what pulls everything. Is what is most volatile. Is what leads everything. So I want to always see the Nasdaq be the one leading. If the Dow is showing it wants to go lower, the Nasdaq may just be the more volatile one, which pulls up the Dow, and eventually the Dow may have to agree with the Nasdaq, and will cause oftentimes consolidation on both. And so that's what I kind of went in with I wanted to see a consolidation. There's also the previous week, which I remember last week when I did my weekly review. I was early in the week. I wanted to see, once we got up here, I wanted to see Thursday, Wednesday, or Friday, or all of those days, to quickly displace back down and leave a big wick here. That's what I wanted to see for a continued bearish bias. I still have a bearish bias, but just for this week, I anticipated consolidation because we did not get that huge wick. We closed up all the way in here, and this, in my opinion, is bullish. I think it would be too easy for prices just continue going right back down to the lows. So it chopping up here, it could definitely get people questioning whether we're going down or higher, and make people run out of patience and just pick a direction and just introduce more liquidity into markets before making another one of these big 1,000 point moves. After all, that first down close week was a historic week, right? We have never really had a drop this big. Well, we have, but I don't remember in how many years. It's been a very long time since we had a huge drop like this in the Nasdaq, percentage wise. And percentage wise or point wise or both, I don't know. And this is the forex market. We have the pound, which I sometimes switch for the Australian dollar, the euro, and the dollar, which is inversed. So I recommend doing -1 times the dollar because I can't see the scale here. I didn't notice that when I did this, but 1 over the dollar is the inverse dollar. And so what you see here is there's S&T, and also you can just invert the scale by right clicking. The only thing is that the candles will, the down close candle will go up and the up close candle will go down, and the colors aren't going to switch. But the dollar's obviously showing bullish S&T, so this could be a retracement higher, right? The dashed line, you see the pound is making that much lower low, so this could be a retracement, short-term retracement, which could make it harder for indices to go lower. And yeah, I also had an experience last week in a Discord where I was talking to some ICT traders and quarterly theory traders, and they were telling me that Wednesday and Friday high impact news price is gonna absolutely fall and go much lower. It's gonna crash on both those days, and we're gonna see another low be created. And I said how I heard a lot of ICT traders last. Was this? No, I didn't talk about this in any video, I think. But um, I was mentioning at the beginning of the week how maybe I mentioned it somewhere in here. But how a lot of people wanted to see lower prices, and I am not part of that yet. I still think we could see a new all-time high. And the news, maybe I did mention this, but if you go to the news, just on TradingView, if you looked at the news last week, they were all talking about, at the end of last week, they were all talking about just stock market crash, stock market reset, a great reset, stagflation, and of course that was because the people were economists were starting to believe that we may not get a, a rate hike this what is it? No, sorry, rate cut this summer, and they were wondering whether we would even get one at all this year. And some people were even saying that we need rate hikes, which is true, but that's not going to happen, unfortunately. So there was a lot of people that were panicking, and basically there was a lot of talk about lower prices. And I knew that right away, that's just not going to happen. Lower prices are not going to happen when everyone is saying lower prices. When the public is saying it's going to go down, it's not going to go down 100%. Fade the public, right? Because most people lose money, and most people are just trying to sell you things, right? Most stockbrokers, Wall Street, all these big news agencies, they're all working with the brokers so that they can make commission. If they want you to sell, who's going to be buying it? The smart people. So I went into the week with that mindset, and immediately, first day of the week, I really didn't expect anything. I don't think much people did. We just kind of chopped around. We didn't do anything, right? We're Monday. So I had this buy side liquidity up here, which is a low fair value gap. That was my target for the week. I wanted to first get into here. That was the first thing. Didn't have to happen on Monday. Didn't have to happen on Tuesday. Ended up happening on Friday at the very end of the week. But I didn't, into the day, I saw at the very beginning at 9 a.m., immediately I didn't really want to trade because look at that 15-minute chart. You see how Asia expanded and then London reversed. It traded back into Asia and did an OTE. It failed to go down to that new week opening gap. So I knew right away that this would be a reversal. Right? We took out the London high. We did an OTE. And if we showing these wicks here and we're failing to really get above London high, I want to see price. I don't want to see price wick like this. I say this a lot often. I don't really like wicks. I love the bodies. When I see the bodies get above the highs, that's when I know it's going to reverse. So this doesn't really sell me the idea that price has really reversed above, or not reversed, but broken this supposed resistance and is now going higher, right? If you're a retail trader and you're buying support or resistance and the public thinks that it's going to run to the fences, the public won't think that when price is down here. The public will think that when price clearly shows that the market structure is breaking highs and is trending. So over here, when we break the high, people see it's trending. And we break another high, people see it's trending. We break above this long-term high, people see it's trending. However, the wicks, this might tell the public that it's being resisted and that there's selling pressure over here. So once we really get above it and we fake, or we really sell the idea, think of a salesman trying to sell you a car. When we really sell that idea that we're going higher, we want to see the bodies really close up here. And that's when you leave a big bullish candle and then a big bearish candle that creates the order block. So I didn't really trust the double S&T and the fact that we're leaving wicks, but I wanted to see an attempt into that new week opening gap. I call this my thank God it's Monday trading setup. Oftentimes when we leave an unfilled new week opening gap, we'll try to go back Monday to fill it. Just like the regular trading hours. Not all the time, but a lot of times, yes. So, see that at around 9:30, closer to 9:30, we open up, bam, the bodies, not on the 15-minute chart, but look on the 15-minute chart how much higher we went. That wick, that's a wick I like, right? Like these wicks here, the slight trading above, that doesn't sell the idea. This wick really does, because think about what people were thinking when price was all the way up here. Right, before it went down, and the body of the candle was all the way up here, showing one big green candle. What do you think people were thinking? They're probably thinking it's going to the moon. They're probably, I'm scared of buying that, but most people are probably more comfortable buying that than selling it, to be honest. And so that is that X there. That's the move that really sold the idea that it's going higher. So we leave an order block and we formed that order block, but this move took out so much, got back into a new week opening gap, that it was kind of over there. There was more ideas I could have looked for, but I was done looking for anything really. I would have wanted to just short to get into new week opening gap. But we did come back down, leave a 5-minute short-term low. Then the candles went beneath that one more time to create a sort of idea that it's now trending lower, and then it created an expansion. This left the breaker on the lower time frame. So this is as it was happening. As price came down, I always look at 9:45 to start my trading. Right, the first 15 minutes of open are usually going to move in a certain direction to grab liquidity, and price is going to oppose that run wherever direction it's in. It's going to oppose it, and so you just wait for 9:30, see which side it hits. Does it go to a discount? Does it go to a premium? And then you after the first 15 minutes, you just try and oppose that and go back to the high or towards that high, or like, low hanging fruit, whatever you want to target. But here I see the range created a low, short-term low. We initially retraced back up. This run down might have gone people short, might have gone people chasing, or if people bought off this range, we're stopping out the early buyers. And at the same time, the Dow is much higher. See how the Dow failed to go lower. That's some divergence there. And we see that the Dow is now turning and the Nasdaq is becoming the leader. So you see at 9:40 we made that low, and then we made this low. Line it up, you see we made another low around 10 while the Nasdaq was going higher. So this is showing that, okay, the Dow is becoming the one that's following the Nasdaq. Even though the Dow went up initially, that was just the opening volatility, but now the Nasdaq is leading. So we hit this low, and this is what I was watching on this screenshot. I wanted to see this to become an entry. I always look for displacement. I saw this fair value gap. I wanted to buy it when price came back and traded into it, and it never did until much later. So you see, it never gave me that entry, and I wasn't willing to take the short because we already did the business down here for shorting. But it did give a nice short opportunity after it left this short-term high. Maybe you can see it on 5-minute chart. Here you see it left a short-term 5-minute high, initially chopped around, faked lower, came back up, same thing as down here, and then it started to trade lower back to that breakaway gap, this one right here. So we come back into that later because that one needs to be filled, and we chop around really for the rest of the day. And this is the SMT that I was talking to you about, when the Nasdaq was coming down, making that low, initially traded back up, made a new low. Right, this was taken at the time where I was thinking about entering 10:02, and it was starting to retrace back into this fair value gap, but it never did get there. You can see how the Nasdaq's making that lower low, S&P is making the higher low, and the Dow's making the lower low. So which one would you want to trade here? It would be the Nasdaq and the S&P, because the S&P is the one you want to trade the most, because the S&P is the one that made the higher low. It never went beneath the 941, 42 low. The Nasdaq did. We see how at 10, where are we at 10? We're up here. Okay, this is at 10:02, so we're at this candle right there. All right, the one I'm highlighting there. And the Dow at 10:02, we are still down here. So the Nasdaq and the S&P are now starting to become the leaders, and the Dow is following it, even though the Dow initially drew higher. So that was Monday. I don't think there's much else to talk about. Oh, this was a 30-second market maker sell model. Pretty cool. And I don't remember if I, hold on. I was checking if I had reviewed Monday's trading. By the way, ICT live stream on Monday. I was focused with that a lot this week. Monday, there was a very good live stream by ICT. That is a must watch. Wednesday too, but maybe Wednesday is a bit more for non-traders too. But for traders, Monday is definitely a must watch for psychological. And I saw a lot of people. He doesn't really talk about price much. He just rants, but they're very valuable rants on Monday that will help you, any trader in their career. So, anyways, we saw And ICT, by the way, when I say ICT, I assume everyone knows who I'm talking about, but the Inner Circle Trader on YouTube. Just wanted to mention that. Okay. So Tuesday I saw a huge move lower. Now that was unexpected, to be honest. I mean, I wanted it to chop around, but when I saw this move lower, on a Tuesday before FOMC, it happens a lot. I've seen many days before the high impact news actually move quite a little bit, and it may leave a large range just to get people short, and then FOMC might come back through it. Sometimes it might just consolidate to build up orders. I don't know, but today was a pretty large range, or Tuesday was. What happened? We had an immediate rebalance. Now, immediate rebalances. I see he talked about this on Monday. Or was it Tuesday? I think it was Monday at the end of the stream. He went into Friday's price action and Thursday, and he talked about this immediate rebalance here. Now, I noticed that there was a breakaway gap, and this is something every time he talks about immediate rebalancing, we're always failing to run into a breakaway gap. We're always failing to come back and trade into a breakaway gap. So when I saw that, I immediately started looking for that same idea, and I found it here, where we left a down close candle. We came back immediately with the next candle, balancing out this candle at the wicks, and then continued to go lower, and it was very explosive lower. It never retraced into this breakaway gap. So the key to immediate rebalance, I believe, is having these breakaway gaps. That's when you know they're not going to fill. If you see a candle, if you see a large range and you see a candle come in immediate rebalance, expect this gap to not get filled, and for price to come back to it later and use it as a target. So I was targeting the breakaway gap down here, and we closed at the balanced price range between the wicks here. Again, this is also a balanced price range, that breakaway gap with that gap there. So a lot of balancing here, lots of price that's already balanced here. One thing I didn't like about Tuesday is that, look at where we are at the midnight open. It was hard to, short for me because we're underneath the midnight open. I did look at something. I said that if I was forced to take something, it would be this play. But because we're underneath the midnight open, I can't take it. Right? We see 830 dump. We see 930 come all the way back up. And then we have a little bit of consolidation. A run above a 5-minute high that kind of sells the idea that we're going higher above this area, filling the 830 dip completely. And the Dow is leaving some divergence. But the Nasdaq is obviously here, not the leader. So there's a lot going against this. And you see that what it really did is just kind of consolidate till probably, the 1050 to 1110 macro, where you would probably see the Dow get more in line with what the Nasdaq is doing. And that's when price really started to run. But I said this is what I would take. It worked. And then I got off and I went to go, I think I went to go watch ICT stream and spend the rest of my day studying. So even though this did work, I did not take this because it was against my rule beneath the midnight open. And that was Tuesday. Now we get to Wednesday. Wednesday was FOMC. So we saw a huge run up in the afternoon to to fill in that candle from Tuesday, right? And then we saw the whole range just taken away in that same afternoon, right? So that's like 180, almost 200 points there, right? We went from about 400 all the way up to 800. Oh, actually, no, that's a lot more. That's like 400 points. So lots of movement for sure over here. Now, I mentioned the breakaway gap, right? When we immediately rebalanced and we closed on inside the balanced price range on Tuesday. And this is basically, right, like something that has not been balanced. It's imbalanced and it was left open. And so this huge dip down after immediate rebalancing, I'm looking at that as a target, right? I'm also looking at the highs. I admit I was potentially open to see the highs be traded to, but mainly on that day, if you go back and watch the recording I did, was the breakaway gap here. That's what I was looking for on that day, and it went up right up into there. I got off when it got on into there, and then I came back to the charts later at night at around 8 o'clock. I saw the whole range was giving up. I'm like, what the heck? I did not expect that down move at all. But immediately I knew that, okay, you could just buy Asia and it's going to go right back up. Right, because remember, a lot of ICT traders are thinking, okay, we're going to be dovish, right? Dovish on, hawkish. A lot of ICT traders thought that Powell was going to be hawkish. Yeah, so that means he's going to say interest rates going up, whatever, and that price is going to crash. So this might have, made a lot of traders think that price is actually going to go down, and an NFP may be actually bad news. It may be manipulation for the bad news for NFP. But no, this was just simply the people that bought FOMC. This just stopped them out, quite simply. You'll see that when you go to lower time frame, FOMC was a two-stage event where both those stages went higher, right? We had the initial release of the statement at 2 o'clock, and then 2:30 was a press conference, and both of those stages prices expanded higher. So there was lots of buyers, and we had just one stop run before continuing to go higher for the rest of the week. There was a small volume imbalance, which I was looking at. I highlighted this before FOMC, or while it was the press conference began, and I did the same thing on the S&P, and it was SMT with the Nasdaq, right? We did the higher low, so I had pointed at the S&P making higher lows, said it looks a little bit better, and there's a fair value gap here that's a bit more clear than the Nasdaq with the volume balance too. And what we would do, we came right back down to volume balance, went up 90 points. That wasn't bad into its own breakaway gap here, right? And then there was the buy side up there, of course. Now this is a one big market maker sell model, but initially we chop until Powell's done speaking at 2:38. That's when price starts to run, coincidentally. We get up to the breakaway gap, which is in blue. This is the Nasdaq, so that's the breakaway gap in the blue line. And we start to consolidate until the last hour macro, 315 to 345. And we start to run lower after trading back to this balance price range there. Right. Notice all these small fair value gaps that we leave open. We leave a lot of them open. We trade back to that one, but we are immediately rebalancing on not immediately rebalancing. That's something else. That's an order block. So we're changing the state in the delivery. The up close candles are no longer supporting price. They're clearly resistance, as you see at the break of each up close candle, here, and here, and then some down here. And we stay beneath that up close candle generally. And so this, if you're short, you would want to see this just resist price and continue getting you lower. But I, again, did not anticipate this range at all. I'm not really going to talk about how you can look at entering or how you can look at anticipating that delivery lower. But these are just some of the things I saw. And that was Wednesday. So Thursday it gets really good. Now Thursday is when you want to trade, because remember Monday and Tuesday we were starting to approach the news, and now the news came out. Now everyone's in the markets and they're trading based off what they heard, based off what the news did. They're all making, well, I'm not going to say they're making a mistake, because if it works for them, then how are they making a mistake, right? But in my opinion, if you're trading algorithmic delivery, you would do yourself a disservice by looking at what the news is doing. um, by what the news is saying, because you're being distracted, which is the purpose of the news, to distract traders from the algorithmic price delivery. So whenever there's news, it's an excuse for price to move, but it's also an excuse to make a whole lot of people lose money, which is exactly what happened, right? So what happened on Thursday? We traded beneath that low on Wednesday on the Nasdaq, boom, right there, and quickly traded beneath that low, and then made our way back up towards the previous day high, right? So you see that very quick run lower. This was just a quick liquidity sweep, probably just to take out any stops from yesterday's move higher that hadn't gotten taken out, right, during this move lower, and maybe get more people short. And then price quickly ran up, and this is pretty beautiful because my model came in, and the exact same thing happened last week. I'll go and show that, but this is where there was more immediate rebound. So let's look back at last Thursday. I talked about it at the beginning, but I'll just show you this picture. Remember, we've had the immediate rebalance, price moved away, propulsion block, right, that down close candle, immediate rebalance, leaving that breakaway gap, and it was very quick to move away. Okay, also notice this range lower that dipped into a level of liquidity, that OTE level. This is a 75% level of a range from the week. It dipped into that, and that run was a run on sell side, run to discount, and that qualified a breaker, the bullish breaker from this low to that high. So when we got above that, price came back into the breaker. That's another way of seeing it, before it ran higher. And it also left SMT, of course. Okay, so that's a good picture right there, that run lower. We traded above that, immediate rebalance, range up. So remember that. Oh, no. And we have the same idea here. Now, I will show you here. This is all the way back August 30th, 2023. This was the first model I've ever developed myself. Well, the first, I guess, model, well, like that I completely developed. I used these ideas all by myself, and it is like just a simple breaker setup, but I'm looking at this usually on the hourly chart. So you see the hourly candles are making the breaker, hourly or 15-minute chart. Then we leave a huge Judas swing. This might be Tuesday or Wednesday, making a move lower, or some day that's manipulating into a discount array on the higher time frame, like the daily chart or previous day low. And this is my dealing range, a level that took, well, that is the high of the breaker, and then the sell side level down here. I'm calling that my dealing range. We draw that out in time. Price gets above that eventually, and then comes right back and moves away. That's the key thing, is that it doesn't spend much time inside this dealing range. The reason why is because this range is completely balanced, and there's a breaker. The breaker is actually completely balanced. And ICT's pointed at this many times, but like, for example, his Reaper PD array, which he doesn't really talk about often, but he mentions it at a couple times last year, because he's trying to probably get people to pay attention to the fair value gap in the breaker, which is a balanced price range. In my opinion, that's why. So this breaker is completely balanced, and that's why when price comes back into it, it doesn't really need to go back deeper, which helps me anticipate when breakaway gaps should stay open. Especially when I see an immediate rebalance, it becomes much, much stronger. So I would also oftentimes want to see a specific time, like the 9:30 open, or news driver, or the 20-minute macros. But we quickly run up to the draw and discount array, and I'm projecting the breaker or the dealing range. Usually I project the dealing range, not the breaker, but the breaker is sometimes the smaller target, and so that's why I'm using the breaker there. 75% of the dealing range. So if you measure that dealing range 100%, 75%, 50%, 25%, 0%. That 75% level, usually you want to see that as very strong support. And price should never really come back to 50%. Sometimes it might, and it will use 50% as very strong support, but you usually don't want to see that, and you usually don't even want to see it get to the 75%. So you can usually leave your stop loss underneath 75%, and price will go into the first fair value gap. That's where I would enter institutional or flow entry drill, and then quickly run up to the discount premium rate. This is, I've been listening to a lot of what's his name, the guy who calls himself the number one ICT trader. What's his name? Romeo. Yes, Romeo. He says that anything else in turtle soup is garbage. Well, this is basically the opposite of turtle soup, because he's entering down here. This model enters all the way up here at the opposite end of the range, where he would be taking his partial and then wanting to see the rest of the move. So I'm sort of getting the leftovers, I guess, yeah. But it's very nice, little drawdown, and it was my way of visualizing algorithmic price delivery when it was little drawdown. So and it's cool because it goes against a lot of the preconceived notions that people have, like Romeo, about price action. And it's a very unique model. I mean, I'm just like that. I like models that are very different from other people. And a lot of people would look at this and it'd be like, well, this is like the very last entry. I'm not saying that this is how I enter, but I oftentimes apply this idea to, when I'm looking at price action, to see, continued upside to my ideas. And like maybe I'm trying to get in down here, I'll look at this and want to see the scenario play out from the entry down here, or from the trade idea down there. So we've had this move lower. The breaker is from this low to that high, right? That range higher up here, right? That's forming the higher time frame breaker. You can even use all the way down from this low, that whole move higher. That could be a one whole breaker, and then price dips into the previous day low and starts a market maker buy model. After it finishes the market maker buy model, it completely runs. I call that model breakpoint. Alright, so this is my breakpoint model, and then the opposite end, when it's shorting, I call it landslide, because it's just landslide because it's a slide. That's how I view it. It's just sliding up to the buy side liquidity. It doesn't come back down. I call it breakpoint. I had no really better names. I just came up with that name. And I'm mentioning the immediate rebalance there. So on that higher time frame, you'll see price coming to immediately rebalance this candle above the breakaway gap, closing above that range and coming back for a breakpoint entry. Look how the bodies respect that small fair value gap. That right there is something that I wanted to see left open. That's how I was able to anticipate that being left open. And then one standard deviation up here in the new week opening gap from a previous week. Okay, so that is what happened. We came back to the breakpoint entry, and then at the last hour, another earnings play took us up to the buy side liquidity inside the breakaway gap. Okay, this was above the previous day high. Now there was second stage for the market maker buy model. You could have also, this would have been a better entry instead of the breakpoint, but this is how you can use, there's a better picture. This is how you can, and compare this to the previous week, right? The last week Thursday, it looks like the same. And this is how you can use, like if I was entering down here on the market maker buy model, I can use the ideas of breakpoint and the immediate rebalance and a breakaway gap to support, not taking partials up here. I'm not saying that you shouldn't take partials, but if you're in a trade idea, you're just tape reading. Support the idea of seeing continued explosive prices higher with much displacement. You can use that in conjunction with that. But here you go. Second stage distribution. So this is the fair value gap for the breakpoint. The first fair value gap on the 5-minute chart. It doesn't go much lower than that, and does not ever come back in here. Now, look at those lows. Remember on the last Thursday, we saw before the break point, there was SMT. So there was the same thing there, right? We're showing how the Nasdaq's making the higher low, the S&P lower low, the Dow much lower low. So who's in the leadership position? The Nasdaq is the one leading. That's the one you want to trade. That's the one you want to take longs on. That's when you want to see price really expand. Don't get fooled by S&T when the Dow is the one making the higher low and you're expecting higher prices, right? Expect consolidation. When the Nasdaq is the one making the higher low, that's the one you want to trade. If you're trading indices, it's the S&P or the Nasdaq. Don't trade the Dow, because if you trade the Dow, you're gonna get chopped up a little bit more. You can still trade it, but you're just gonna get chopped up more. And I don't know why you would trade it. It just doesn't make sense. Maybe you like leverage or something on it. And the S&P as well, it's a bit closer to the Nasdaq, but the Nasdaq is clearly the leader in bearish and bullish markets. It is the leader. So just remember that. It has some of the biggest companies in the world, and when those companies move, the whole market moves. And you see prices consolidating. We move at a macro time after leaving the SMT. You just wait for the macro time retracement into the volume imbalance there, in a discount, small breaker, and then bang. Right, that is like the dealing range. That's the break point. That's a break point entry. That fair value gap there, that's the break point entry. This dealing range, when price comes back into the dealing range, or etc., slash the breaker, price runs higher, and it's very, very quick. Little drawdown, right? So that concludes the Thursday. And Friday, I just showed this. Not much happened Friday. It was NFP. So we delivered finally to the high I wanted to see. The Wednesday or the Monday high, the high of the week, and the fair value gap, which I don't show because I took it off, but yeah, so I had to delete it and change it to that high, just so I can make it more clear for the picture. But yeah, that's it for today, for this week. But